Hi, I'm Hamlin Lovell, contributing editor of the Hedge Fund Journal, and today we are sitting in the offices of Old Mutual Asset Management in London, overlooking the Thames River. Today we're talking to Old Mutual's Managing Director of Alternatives, Donald Pepper. Well, Donald, thanks very much for agreeing to talk to us today and telling us more about the spectacular growth of Old Mutual's alternatives business.
Yeah, thank you, Hamlin, and thanks actually to Hedge Fund Journal, because I know you came and saw us 2 years ago when really we were just getting started on this.
So what has been driving all this asset growth?
It's been a number of factors, I'd suggest. Firstly, we really do have some first-class managers who have delivered what we've set out to deliver. I think the main focus has been really in delivering a diversifying asset, so with a big focus on low or indeed uncorrelated returns, and in particular the global equity market neutral strategy. That has been a prime focus of it, and it's actually achieved that. So we have two versions of it, which we can talk a bit more about later, but there's a UCITS version and a Cayman version, but both of them have achieved this virtually uncorrelated return stream, and that's, along with a number of other changes and enhancements we've made, has been one big driver. But in addition to that, it's pleasing to see that we've also seen growth from other strategies as well. So we have a global statistical arbitrage strategy, which we've raised a decent amount of money from new sources for. We've raised money for our UK equity long-short strategies as well, albeit in smaller amounts than the equity market neutral strategy. So I'd say it's reasonably broad. But definitely the big focus has been on, I guess, the liquid alternatives, as it's called, UCITS vehicles. That's where the bulk of the assets have come, as well as some into the Cayman funds.
With assets now at $3.7 billion as of year-end 2014, how fast has the growth been since you came on board?
Yeah, I mean, so effectively 2 years ago it was just about 800 million. So we've gone from 800 to 3.7. In fact, as we sit here today, it's just over 4.1 billion 2 months after the year end. And the bulk of that, I mean, the UCITS fund, when I joined just about 2 years ago, was 78 million, and that's now 3.3 billion. So that, without doubt, is the fund that's really garnered investors' enthusiasm the most. But as I say, we've also raised, getting on several hundred million away from that as well.
With assets growing so fast, do the staff still account for 1/3 of the asset total, as they did when the Hedge Fund Journal profiled you a couple of years ago?
I certainly wish it was. Yeah, no, exactly. There was a time when, particularly, I think there was in the UK Specialist Equity Fund, exactly, it was around about 1/3 from both staff and seeding money added up. Now I'm very glad to say we've got a lot of money in from third-party investors. So the actual proportion of assets has really dwindled, but the aggregate dollar amount has increased quite notably from either staff members and also from the Old Mutual group as well, to some extent. And basically there is a culture very much of investing, of having the managers in particular having the skin in the game, investing, eating their own cooking, and that still continues. A large proportion of the performance-linked pay that managers receive, is deferred for 3 years and has to be placed into a fund managed by Old Mutual, and the managers, not unsurprisingly, generally will pick their own fund. So it is definitely a growing dollar amount, although I think over time I very much hope and expect it will become a smaller and smaller percentage amount as we get more support from external investors.
So is AIFMD actually increasing the amount that managers invest in their own funds, or did they always eat a lot of their own cooking anyway?
I think AIFMD is having a positive impact on that, and I'd say that I'd expect the proportion that is actually deferred will increase over time. It's a significant portion, but I'd say that it's highly likely that that'll probably increase, and I think that's a good thing for investors and alignment with managers and investors. So I think it's raised the level of debate and probably made people think about it a bit more and realise it's a good idea to be more aligned with investors.
In terms of the culture of a firm, how important is it for investors to see that a hedge fund manager is signed up to the Hedge Fund Standards Board?
I think it's a statement of intent to my mind. I'm a big believer that it encompasses a lot of very good values. It's interesting. I'm kind of surprised that investors haven't proactively come to us to require us to be signed up to it. But I've signed up in 2 previous firms as well because I just think it's the right thing to do. And it's been a good exercise. We actually engaged a consultant, a specialist external consultant, to really help us and go through all the current practices as they were, to see whether we measured up. And in fact, we found that even though we thought we had high standards, which we do, there were certain things that we could improve on. So, as an example, previous to this, the firm's board only had meetings 3 times a year. The recommendation is for them to be quarterly. So based on that, and to sign up with the Hedge Fund Standards Board, we've now the board's agreed that they'll meet 4 times a year. There's a number of other small changes like that. We're basically agreeing to explicitly provide disclosure where there wasn't that explicit guarantee. We would have done it on, for example, illiquid assets, were we to ever end up holding any of those, not expecting to in our strategies. So yeah, I think there's a number of incremental improvements, and I think the fact that we went through that rigorous process, we now can say, yes, we are signatories, and we can actually explain why, point by point, we're confident that we do actually comply. It's been a good little, kind of maintenance test for us, and I think it is something that investors, I'm hoping, will be pleased we've done.
So being part of a larger asset manager certainly brings some advantages in terms of corporate access and research resources. But it can also create potential for conflicts of interest. And we recently saw that Aviva, the UK's largest insurance company, has apparently been misallocating trades amongst accounts and allocating more profitable trades to accounts with performance fees and less profitable or loss-making trades to accounts with lower fees or no performance fees. Could this ever happen at Old Mutual, and what safeguards exist to prevent such things from happening?
Yeah, I think it comes down to the culture of the organisation, and I mean, it somewhat surprises me that these events tend to occur every 4 or 5 years, that somehow internal controls at organisations somehow allow this to happen. What we definitely, we're always looking to dynamically improve, dynamically learn, dynamically make sure that we have best practices and that there isn't anything we're missing. So further to that, our compliance department went right through the analysis of what happened, what went wrong, made absolutely sure that everything we do would have prevented those transgressions happening, if you like. And we're very comfortable that we already had in place all the safeguards. So, without going into the details of that case, but there's 4 or 5 very clear things that went wrong that ought to have been prevented at various different stages, and somehow all 5 of the safeguards didn't fall into place. So we double checked that we were very robust on that. So yeah, I think in some ways I'd have actually expected, I'm surprised it was at such a big organisation, because I'd have expected that to be less likely at a big organisation. I think often investors take comfort from something like an Old Mutual Global Investors, which is owned by a FTSE 100 company, that we're going to absolutely not cut any corners on items like that, and we certainly don't. But I think it is beholden on all of us to constantly reevaluate that, make sure that there's nothing that may have changed that we're not paying full regard to. Just taking the first part of your question though, yeah, I think being part of a large asset manager is a definite benefit. We're finding that especially in the UK fund, we run a large amount of long-only UK money that allows us tremendous corporate access, and that's definitely helped the discretionary managers there, for whom corporate access is important. And there are other economies of scale in terms of the calibre of legal and compliance and other trading resources that all the hedge fund managers, as well as the alternative UCITS and long-only managers, all benefit from, and therefore their investors benefit from.
We hear that your head of UK equities, Richard Buxton, is ramping up the corporate governance drive by more proactively voting on remuneration issues. Does this mark a move towards a more aggressive activist stance that could even see Old Mutual launching an activist hedge fund? Or is this really restricted to specific issues on remuneration?
That's a good question. I think specifically Richard has been known for being willing to be vocal when he really feels that management can do with a bit of advice. He recently in fact hired a gentleman, Paul Emerton, to come in as head of UK stewardship and governance, to really spend time looking at issues where a company's share price might be improved by the management paying attention to some deficiencies or areas of potential improvement. I think his approach has really been to try to work with management in rather than confronting them, if you like. But there are times when I think things have to be said, and I think Paul felt this was one where really it comes down to misalignment of interests, and you can't. I think he had a real sense that failure was being rewarded in the longevity of some of the contracts with board members and other executives. So he felt this was something that was worth making a stand on. But basically, and right now there's no plans currently to launch any activist hedge fund strategy, but it clearly is one that investors see value in, and it's certainly something which down the road I wouldn't rule out if we felt we could do it particularly well. And certainly having that kind of experience and that of Paul Emerton would certainly be something that could lead us to go in that direction.
Do you think that management fees in the hedge fund industry in general are too high for a world of low inflation and low interest rates, indeed sometimes negative interest rates?
Yeah, I do, yeah. I think we've been very clear to be very conservative on our management fees. And I think a lot of this is led by talking to investors. Investors are concerned about it. If they're concerned about it, we're concerned about it. Investment consultants are concerned about it. We're concerned about it. I think the way a lot of investors think about it and consultants think about it is there's the share of the alpha that should be retained by the people who, after all, it is their money. And I think there's a strong sense that they should retain at least 70 or ideally up to 75%. To pay more than that out to the alpha generator, begins to look a little bit toppy. So therefore, we've deliberately calibrated our fees to have a lower base rate and also to introduce, by the way, a cash hurdle rate, so that we're not charging, if and when rates go up, we're not charging just on the short sale proceeds cash rebate that we receive as performance when it really isn't. Look, we're being very, I think, understanding of that issue, and we're really trying to make sure that we deliver value for money. To my mind, it's not the absolute level of fees, it's the fees per unit of alpha, and especially fees per unit of uncorrelated or diversifying alpha. That's the key, to make sure you've got value for money in that, and certainly ratcheting down the base or the management fee is one of the key tenets to help achieve that.
So you introduced LIBOR hurdle rates for performance fees. Are these rates floored at zero so that investors would not pay a performance fee on negative performance, even if the relevant currency share class had a negative rate on that currency?
They're not, no. So effectively, and I think that's fair, because effectively what we're saying is if rates, for argument's sake, go up to 4% and we made, say, 10 to the investor, we're saying the first 400 basis points, we're not going to charge performance on that, so we'll just charge a performance fee on the 6. But if our argument's sake rates went down to -4, what you're saying is your opportunity cost for your money is -4. So were we to achieve a -1, they're 3% better off, and therefore it's only reasonable that is genuine performance if we delivered it in an uncorrelated way. I don't think we'll be down to those levels, and hopefully be a relatively moot point. But there certainly is nothing in there that currently sets the performance fee hurdle rate at zero as it stands.
There's some debate in the hedge fund industry over how important star managers are relative to teams and processes, and recently we have heard that Old Mutual will be losing one of its star managers, Ashton Bradbury. When did you first discover that Ashton Bradbury had plans to retire?
Yeah, so Ashton let us know officially in September of last year. Tim Service had been working as his deputy portfolio manager for pretty much the last 3 years up to that point. So it was a relatively easy transition. What Ashton agreed as part of that with us was that he worked through to the end of the year. So there was another further 3-month transition period where Tim became the co-manager with the view to becoming the lead manager, which he now is. We then engaged with all investors. They had plenty of time while Ashton was still there. It was a monthly dealing fund to take out their money if they wanted to. One investor halved their allocation, but I'm glad to say kept half of the money in there, having got enough comfort that he felt Tim would be good. And most other investors actually kept their money in as well, so I'd feel that was managed reasonably well. And assets are actually, basically up somewhat from a year ago, despite Ashton having left. So, I think that's testimony to the fact the team impact on that was understood by investors. In other funds, we have very much a team approach. So, the global equity market neutral team, run by Ian Heslop, Amadeo Alantorn and Mike Servant. That's a clear co-portfolio management team. Interestingly, they have got two analysts who have both been with them for longer than 6 years. They've all been at Old Mutual running this type of strategy for over a decade each. So it's cumulatively well over 45 years of aggregate experience at Old Mutual running the strategy. It really isn't down to one person. There's a lot of tenure, a lot of experience in the team there. Taking another hedge fund strategy, our global statistical arbitrage strategy, that's run by Paul Simpson and John Dow. As a team, they worked together previously at Millennium, and prior to that at places like UBS. They've worked together for 2 decades, and within Old Mutual, they work alongside Leif Cusson, and the three of them together have over 20 years of experience at Old Mutual running and developing that Stat-Arb strategy. So it's certainly the case that were any of the key members to leave, that would be very important and would require us to have conversations with investors. But I think do feel, and I think the UK example with the Ashton, Bradbury and Tim Service is one where we'd very much hope that we could find continuity and investors willing to continue supporting if the bulk of the rest of the team stayed with the fund.
So do you have succession plans in place for all of the key fund managers?
I wouldn't put it quite like succession plans as such. So I think the global, I think that they are a team, and there's no specific succession management. But what we do feel, for argument's sake, if one of the team were to leave and the rest of the team were to stay there, we'd expect there's enough shared experience and that really we'd hope that there'd be enough belief by investors that there's sufficient continuity there. If you get more than 2 of the team leaving, that becomes more questionable, frankly. And then you'd really have to we'd have to engage with investors and see what they thought. But I think the idea is that we're not reliant on just one star, that it is a team approach. Let's put it that way.
More broadly, how is Old Mutual balanced between quantitative and discretionary fundamental investment processes?
Yeah, so overall, we're very much a focused investment boutique. We're not a massive asset manager. We run about $32 billion in total, and of that, around about $5.5 billion is in quant. So whatever, around about 1/6 of the assets. In the hedge fund alternative UCITS side, it's more concentrated. So in that case, probably a good 80% of the assets are driven from the quant processes, especially given the success of the equity market neutral strategy and more recently raising assets. I feel that's a really good place to be. I think quant is, or a kind of a quant approach, is one that's very complementary in many ways to discretionary approach. So one can argue, if one's got a number of discretionary managers, actually having a quant manager who looks at the market and looks at stock selection in a very objective way and squeezes out behavioural bias, it can actually be quite a good diversifier, even in the same investment asset class. Say, call it UK equity long short, call it global equity long short or market neutral. So yeah, we're very happy that we've got some of each.
Did the launch of your Old Mutual Arbea fund actually have to be a Cayman fund in order to achieve the higher volatility target which it is designed to do?
Yeah, that's a good question. What we did when I first came over here was talk to a number of investors and ask them about the calibration of the UCITS version, which is a volatility of 5 to 6, with the intention of seeking at least cash plus 6% returns, and has been successful doing that. So currently it's basically having a vol of around 5 and returns of cash plus over 7. But there are a number of investors who have higher return targets. They may be, particularly in North America, pension plans who have, say, an 8% target, and so cash plus 6 is not going to do it for them. So they were saying they'd rather have more volatility. So for 2 reasons, we therefore decided to launch a Cayman fund. One was to basically have the correct volatility versus return expectation calibration to appeal to those investors with a higher risk tolerance but higher required return, expected return. And secondly, North American investors in general can't buy UCITS. So it really met for 2 criteria. It also allowed us to engage with other offshore investors who may prefer prefer the structure. But to answer your question, we could absolutely, within the UCITS rules, it's such a diversified strategy, there'd be no problem hitting the 5-10-40 rule, no problem hitting the diversification and the volatility target. So already the gear fund already is a sophisticated UCITS fund. So we absolutely could have launched that as a UCITS vehicle. It was more with a view to the North American institutional market that we decided to do it via a Cayman route.
Looking at new launches elsewhere within Old Mutual, a while ago you seeded Simon Murphy for a UK equity hedge fund. How has that been doing?
Yeah, so Simon Murphy has done really, really well. I mean, he's had a terrific long-only track record in UK larger cap equities for a number of years, and has actually now been running this fund really mainly on our money for the last 3.25 years, since October 2011. And he's annualizing it as of the end of the year at like 8.8% with a 4% vol, so a sharp, nicely above 2. Very minimal drawdowns, and it's the kind of and very variable net. So as we sit here today, or certainly as of Friday, he was minus 20% in terms of his net beta exposure. So he's willing to be contrarian, willing to move the net around. And I think we're feeling hopeful that there's a lot of investors who are willing to we've been engaging with, and we hope to see those assets grow. And certainly, I think his track record would lead us to believe that it ought to merit more assets coming into it.
So, as well as seeding funds internally, is Old Mutual active in seeding new hedge funds externally?
I mean, I think what we've tended to do is going back a little bit to when you asked me about the Hedge Fund Standards Board, and what we're trying to do is we're setting up a first-class institutional quality infrastructure at Old Mutual. So we tend to say to investors, why wouldn't you want to come and join us and apply your trade here? Everything's plugged in, we've got all the compliance, legal infrastructure, support for you. And that's historically the route we've done. We've been very flexible in that. So, for example, last year, Old Mutual was successful in attracting Russ Oxley and his team, who used to run the Ignis fixed income absolute return government bond fund, and they were running around about $6 billion. They've agreed to join Old Mutual Global Investors. In basically, part of the way to attract them was to be flexible on where they wanted to be situated. So we'll shortly be opening an Edinburgh office, but they will be employees of Old Mutual Global Investors. Similarly, on the long-only side, we attracted Josh Crabb on the long-only side, as I say, in Hong Kong, who was at BlackRock, had an amazing track record in the long-only space, and we've therefore already opened an office in Hong Kong to run money from. But again, he's an employee of Old Mutual. But I think it demonstrates we're willing to be very flexible, and I think I wouldn't say never on potentially giving money to someone not a whole part of Old Mutual, but it's not currently in our plans.
And going forward, which asset classes, strategies or fund structures could Old Mutual be looking to develop? For example, you've already launched a Cayman vehicle, partly to appeal to US institutional investors. Would you ever consider launching a 40 Act fund to appeal to US retail investors as well?
Yeah, I think the 40 Act is definitely obviously a very interesting space. There's a lot of assets that are being attracted into it, and I think that's going to be a cyclical trend of assets going into it. So it's certainly something we're examining. The one worry I have about the 40 Act is there is this risk of negative selection bias, because basically as it's structured, you really can't charge a performance fee. And a lot of the assets that we run in the alternative space absolutely, in my view, merits, and by the way, in the view of investors who have poured a lot of money into these funds, merit the performance fee. So then we have to say, why would we sell it that cheaply? Then one can examine, well, could we maybe do a version of it that's still a good version, but not the optimum version, that maybe gives us the ability to have more capacity in a more capacity constrained strategy, because say we weren't doing double alpha on both sides, but maybe doing some kind of slightly watered down version, which, as I stress, would still be a very good risk adjusted version, but take up less capacity. So we're kind of maybe investigating, thinking along those lines, certainly feel that it's an interesting space. I do like the fact that under UCITS you can get the full fat version of many of the more liquid strategies. It means you can still get basically a lot of or pretty much all of what you'd expect from a Cayman fund, because you are paying the same type of fees, and therefore you're attracting the same first class managers with the same full fat version of the strategy.
Well, Donald Pepper, Managing Director of Alternatives at Old Mutual, thanks very much for your time today. And we at the Hedge Fund Journal very much look forward to watching the continuing growth of Old Mutual's alternatives franchise.
Great, Hammond. Thank you. Good to meet you again.